Good evening, I'm Alessio, and welcome to tonight's Business and Finance Update. In recent days, we received a trio of impactful developments, two steeped in misconduct and regulatory consequences, and one defined by achievement in the advisory industry space, offering a powerful snapshot of how risk and reward continue to shape finance. First, in Nebraska, a troubling case came to a head when a financial advisor was sentenced to prison for conspiring in a multi-million-dollar bank fraud scheme. According to the Nebraska Examiner, this advisor helped secure loans on the basis of grossly inflated or fabricated collateral, deceiving lenders. Nebraska Examiner. The alleged scheme revealed that claimed investment accounts simply did not exist or held far less than represented. The implications for banks and for trust in advisory relationships are serious. When institutions that should serve as gatekeepers are duped, the ripple effects extend far beyond one firm. Simultaneously, another story shows how the regulatory net continues to tighten around financial misconduct. In the earlier stages of the case, the Federal Bureau of Investigation and other agencies flagged the effort to obtain roughly $45.65 million in loans from 19 different institutions across Nebraska and western Iowa. Department of Justice, the advisor, via investment entities and control agreements, misrepresented account values, misled banks about existing liens, and facilitated loans that would later collapse. The case underscores how the intersection of real estate ventures, investment representation, and lending can become a fraught field if oversight fails or collusion prevails. So here's the risk lesson for investors, creators, and advisors alike. When valuations, collateral claims, or financial assets are overstated, the damage isn't just to balance sheets, it's to reputation, regulatory standing, and trust. And in today's environment, trust is a rapidly depreciating asset when shaken. Turning to the third story, not all industry headlines are about failure and fraud. Calamus Investments made news by being recognized by Forbes among America's top RIA firms for 2025. GreekReporter.com. The firm, founded in 1977 and led by CEO John Koudounis, has grown appreciably, expanded its liquid alternatives business, and further cemented its status in wealth management circles. The recognition is not just symbolic. Underlying it are criteria including assets under management, growth trends, and client service, per the algorithm used by Shook Research for Forbes. WM.Celamos.com. What this achievement signals is that the advisory space is evolving, not just chasing high returns but client engagement, alternative strategies, and resilience across market environments. The success story here stands in contrast to the earlier firm's downfall, reminding us that sustainable growth, transparency, and discipline matter. Piecing these developments together, we observe a broader narrative. In financial markets and advice industries, the margin between success and failure is razor-thin. On one side, misconduct and misrepresentation can destroy not only firms but the institutions they engage with. On the other, firms that embrace innovation, governance, and client-centric strategies can earn elevation and recognition. From an investor's or creator's perspective today, three watchpoints emerge. 1. The strength of a firm's governance matters. You'd be wise to ask how well collateral or investment values are verified, how incentive structures align with client outcomes, and how much transparency advisors provide. 2. The growth of alternatives and liquid alts is no longer niche. Calamos's rise shows that strategies beyond traditional equity/fixed income are becoming mainstream. And 3. Regulatory risk is on display. Bank fraud cases like the Nebraska one remind us that in times of stress or opportunism, the cost of misrepresentation can be astronomical, not just monetarily but in legal terms and career impact. I believe we are witnessing a pivot moment in wealth management, one where the winners will be those who combine innovation with integrity. The best-performing firms will not only deliver returns but do so under strong compliance, clear communication, and a diversified matrix of strategies that protect clients when markets wobble. At the same time, any cracks in governance or oversight will stand out, and in a highly connected era, reputational damage is swift. For you as creators, communicators, and investors, the message is, tell both sides of the story. Don't just highlight growth or performance, expose the guardrails, the checks and balances. Because if you understand the architecture of a firm, you're better equipped to assess whether its rise is built on substance or whether it's skating on thin ice. So, that's our look tonight, a cautionary tale of fraud, a blueprint of recognition and growth, and a reminder of the duality in today's finance ecosystem. I'm Alessio, thank you for joining, and as always, stay observant, stay discerning, and keep your finger on the pulse of business, finance, and advisory trends.